You think markets are getting ahead of themselves. What do you mean?
I think, and I think Kathleen touched on it, if you look at the policy choices that the Federal Reserve and the White House has right now, it's really simplistically put that if you allow unemployment to rise by 2 percentage points, you will impact 6 million people. If you don't fight the inflation, you will impact 300 million people. And that, of course, both plays into the midterm and the next U.S. election, but also overall on the ability of the economy to recover. So I think that's lost by the market. The market is very focused on this continued talk wherein, 20 and 21, we talked about transitory. Now we talk about peak. But at the end of the day, we haven't changed the energy mix up. We have done a lot to increase the outage that we'll see this winter. And note, in Europe last week, UK was minutes away from having a power outage, only saved by the fact that they paid £9,700 for a megawatt out of Belgium. So, the energy system, the energy component will continue to rise. And now we see the second round effects, which economists, of course, fears the most, which I also think was behind the ECB move, being more aggressive. So basically, as you just stated, the employment side is strong. The private balance sheet is the strongest ever. That's why the model of seeing a material impairment of growth is not working. That's why IMF is wrong. That's why the consensus is wrong on growth. We are going to be higher inflation for longer, and we're going to have a less shallow sort of move down in growth.
And you've been flagging as well, financial conditions are actually easing. Despite all this talk of 75. What happens after 75 today then, Steen? What should I be expecting in terms of term rates, where the unemployment factor is going to be too?
So the market tonight is looking for some kind of dovish interpretation that they can have on this. But going back to my core view that I just stated, I think it's very unlikely. I think they come out hawkish again. They still continue to talk very tough. And the concept that interest rate is going to peak in December, which is pretty close to the coldest month in the year, is just unrealistic to me. I think the market is living on a pipe dream here, and it wants to believe that this is going on. Again, go back to last year. We talked transitory all year until the market reverted and finally accepted when we had the pivot from Fed in October, November of 20. That ever since that, we've pretty much been having the same conditions.
Right. And Steen, as CIO, what's the action then? Is it what short risk, long vol? Have your therapist on speed dial? What is it?
The therapist, excuse me, the therapist and speed dial is always a good idea, I guess. But, we run the asset allocation from a multi-asset allocation perspective. So at all times, we have the same allocation to equities. We are monthly rebalancing it. So it's not like we are going out on a limb and trying to be very aggressively short and active here. What we're doing, however, is that we are overweighting energy, we are overweighting commodities, we are overweighting cybersecurity, and we are overweighting logistics and green transformation in the equity component. On the interest rate side, we are doing more floating rates than fixed rate. And certainly, as you indicate, we have long volatility as a play at all times, in good times and in bad times. And on top of that, we have exposure to gold. But all these asset allocation are fixed. So really, the performance is going to come from multi-asset allocation, which, for the record, is the only free option in financial markets.